Welcome to Stocks in Translation. I'm Jared Blickery, your host, along with Sydney Freed, the voice of the people. We're going to get started in a second, but first, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today, we are welcoming back Callie Cox. She is the Chief Market Strategist at Ritholtz Wealth Management. It's great to see you again here, Callie. And today, we're going to be talking about the outlook for 2025 as we close the books on the first quarter century of this millennium. Our word of the day is productivity. We're squeezing more and more out of each worker these days, what it means for the economy and for stocks. And this episode brought to you by the number 8.5%. That is the biggest drop of the S&P 500 this year. Will investors be buying the dip in 2025? All right, Callie, a lot has happened since the last time we saw you here. What have you been making of the recent market action?
Well, it's been quiet, Jared. You're right. A lot has happened, but not in markets. It seems like the world has almost exploded around them and markets have ignored it. But of course, we had the election. I think the last time I was on was in October. So we had the election. Yes. Markets took the pro-America trade and they ran with it. And now we're quietly meandering along at record highs.
Do you think it's going to be quiet for the rest of the month? Santa Claus rally?
Well, I sure hope so. But no, you're going to hear that phrase a lot this year, Sydney. And I'm glad you brought that up because everybody on Wall Street loves to say, oh, it's the Santa Claus rally when stocks just, quietly move higher in December. And I actually think that phrase is overhyped.
Really?
Why?
Yeah.
Because I only hear it 500 times in December. Yeah, so
only 500.
I agree with you there.
Yeah.
But we're going to circle back to the market action. I want to dive now into our word of the day, which is productivity. Now, productivity measures how efficiently goods, that output, which could be goods or services, is produced, typically calculated as the total output divided by the total input. And that input could be labor hours or resources used. But this is a topic that you're really focusing on in your 2025 outlook. Why?
Right. So productivity is the best economic trend you could hope for, guys. So Jared, you explained it really well, but it's basically the output that we squeeze out per worker. So it's economic output per hours worked. And, productivity is such a loaded term in today's society. How productive am I? Am I scrolling on social media? That's not very productive.
We measure it by how much we use ChatGPT.
Correct. Well, that's part of the story.
All right.
But it really is about the job market. When you talk about productivity, it's the antidote to inflation, and it's the almost the solution to higher growth. The strongest economies we've seen in history have correlated with high productivity.
Late 90s was a recent one. And I think, is that the most recent example? I mean, that was the era of Greenspan, the dot-com bubble, all that good stuff.
I think so.
Productivity.
I think so. That's the one that sticks out in
Wall
Street's mind. And, if we're being technical, productivity growth right now is the highest since the mid-2000s. But that was really what culminated with the rise of the internet and kind of almost the rebound that we had after the tech bubble.
How do you measure productivity, though? Like, if I'm thinking about my own work,
no?
Yeah, I'm just like, oh, am I double timing it? Like, how do we measure?
Yeah, that's a great question. And actually, my analyst, Sean Russo, asked me the same thing today. It's a bit of a derivative of money exchanged. But if you think about GDP, it's all that an economy generates. It could be that haircut that you get when you go to the hair salon. It could be that TV that you bought during Black Friday. It's a culmination of a lot of different things. It
could be a subway ride.
It could be a subway ride. But think of it as what is generated by money exchanged.
And so how does the stock market relate to productivity?
Yeah, good question. Because I love talking about economic theory, but we're here to talk about the markets, right? So productivity touches the stock market in a number of different ways. First of all, markets follow the economy and earnings over time. So if there's a strong economic trend happening, in the economy, then you're probably going to see that filter into markets, even if it takes a while, even if there are some disconnects. But productivity, the way that we boost it is by, empowering workers to either learn better skills or giving them the tools they need to do their job better. And both of those are a great story for you and I, the common employee, by the way. But why it relates to the stock market is that it helps companies keep costs low. It helps benefit certain sectors that kind of contribute to these productivity gains. And right now, the productivity surge that we're seeing is really a product of the job market and Americans being historically employed for, about 3 years now. But Everybody's talking about AI. Obviously, AI can make you more productive. That could be, the second leg of this product.
Yeah, let's talk about that, because there's been a bit of disappointment about the monetization so far, and I don't know what we were all expecting. Like, is it going to be something like ChatGPT is going to knock down your door and everybody's going to buy a Copilot subscription? It takes time for this stuff to filter in through the economy, and I'm just wondering what signs are we seeing now? Like, what kind of companies are we looking for to take off, maybe to participate in this AI trade as it finally works its way into the economy?
Yeah, well, this year was all about the picks and shovels. NVIDIA, best example of that. NVIDIA is not the one rolling out the chat GPTs of the world, but it's the one providing the chips for neural networks and machine learning. So the companies that are tangential to, AI products that we got excited about in 2022 are really the companies that did well this year. A lot of power companies within the utility sector are another good example of that. So when you talk about monetization, though, we're not really seeing it yet. There's a lot of hopes and dreams, but there aren't, tangible profits. Even NVIDIA, their sales have been boosted by, the sale of their chips. And apologies, I can't remember the name of their AI chip, but NVIDIA's
Blackstorm.
something like that.
It's embarrassing that I don't.
Blackwell.
I know, I'm having a brain fart. Yeah. But even NVIDIA, seen higher sales, seen decent profits, but hasn't really been able to tie the two together. But you have to remember, the story is still early. It's a concept, and that's okay. I think you have to keep that in mind when you're investing in AI-related stocks, but these things take time.
So what do you see in terms of performance of AI and the broader tech sector?
Like, do utilities keep going strong, or how does that factor in?
Yeah, so at Ritholtz, we're telling investors to be really careful going into 2025. And this isn't necessarily an AI story, but it has to do with just the stunning rally that we've seen in tech stocks. Obviously, tech is the most interesting catalyst of the year this year. It's one of the reasons why the S&P is up 20+%. And look, the S&P
2 years going too.
Yeah. Tech has led both years. Tech is really the superstar of the market. And that's great, but you have to think about balance, especially if you're a longer-term investor, thinking decades or even years ahead. So we've been telling clients to think about balance, especially if you're worried about how expensive the market is. The market isn't just tech. There are other sectors that are less expensive. Yeah.
Well, let me, I had a really good question there for a second, but let me just expand this. All right, so we're talking about some of the sectors and industries that might be great in 2025. How are you thinking about them right now? How should an investor be preparing to buy that proverbial dip, for instance?
Yeah, well, I think right now you need to take a good hard look at your portfolio. Think about balance again. If you see that you have some really good gains in some stocks, maybe think about, taking some of those profits, rotating into more unloved areas of the market. Obviously, we're at the end of the year, so think about tax loss harvesting or keep taxes in mind when you're making transactions. But I think on the whole, just don't be too nervous, but also keep your expectations low. We've seen an incredible 2 years.
But if you have a really long runway,
like Sid.
Like
She's
me,
young. She's young.
This is basically just for me. Don't you think tech is kind of still the way to go long term? Or
we have a number of guests who are saying, don't buy utilities, don't even buy the Dow or the S&P 500, just buy the NASDAQ, buy crypto. You'll be. Not everybody, but that's kind of a theme that younger investors, they need they can just afford that extra juice to kind of swing for the fences early on, or is that not advisable?
Yeah, it's not a bad idea. The problem is not many people can handle the smoke that comes along with crypto and tech. Tech, we'll start with tech. Tech is the superstar of the stock market for a reason, because you take on a lot of risk to get those returns, and it is a sector of hope and dreams in a way.
I like hope and dreams.
Not big tech. Those are some of the strongest companies on the market. But looking outside of big tech, you have a lot of younger stage companies in public and private markets that you have to be really careful about. But they are kind of the sexy attention-grabbing names that everybody talks about. Crypto, same bucket. I think the crypto space is really interesting. I love learning about developments in the space.
And the token names are just great.
I know. I laugh over them every day. But like crypto is also a young, maturing asset class. Even Bitcoin. Just 2 years
Crypto's younger
ago.
than Sid here.
Is it?
Yes. No, 2008.
Oh, yeah. Yeah.
Okay.
I had to think about it for a second. It's true.
Yeah, well, exactly. And that's not necessarily a bad thing, but you have to understand the ups and downs that can come with that.
What are the sectors you do like then, besides tech or outside of tech? Since we're talking about balancing.
Look, I think tech has some really interesting stories, but when you're looking over the next year, you have to think about valuations and again balance. And my mind naturally goes to the economy and where interest rates are heading. So I'm thinking rate sensitive sectors, banks, real estate. I think consumer discretionary could be interesting, although half of consumer discretionary is Amazon and Tesla, so you have to
Right.
be careful. But economically attached rate sensitive sectors could be really interesting, especially if the economy holds up.
One of the things you noted to us, and I want to highlight here, is that earnings breadth is pretty good right now. And in fact, in 2025, every S&P 5 sector is expected to increase its earnings, is expected to grow. That hasn't happened since 2018. So what does that mean to you?
It means this rally that we've seen is for real. It's
So
a great sign for
how does that
analysts.
square with your caution? Like, you see all that earnings growth. Could investors be getting ahead of that and saying, well, it's easy to get too far ahead of the curve, but how do you think about that?
Right. Well, what you said, Jared, is exactly how I think about it. It's a great sign. Look, I'm not going to complain about profits growing, especially when there are a lot of questions about the economy and if there could be the big proverbial R word coming in 2025.
We won't say that here.
Don't say it out loud. He who must not be named.
But earnings growing is a good thing. My worry is that, yes, we've pulled a little bit of this forward and we might be setting the bar too high in 25. And that's not saying that profits are going to fall off a cliff, but earnings expectations are pretty steep. I think earnings are expected to rise by double digits, at least S&P earnings. So you have to think about markets as the information coming in, but also the expectation of that information. And part of this rally that we've seen in the back half of the year has been on the expectation of profits broadening in sectors outside of tech.
Excellent. We're going to pause right here for a second. Coming up, we're going to be talking about buying the dip. Plus, the Fed's dual mandates. They go head to head in today's Who Wore It Better? This episode is brought to you by the number 8.5%. That was the biggest drop this year, which is very small historically, for the S&P 500. And that's not even correction territory, which is historically 10%. But two back-to-back years of 20+% returns in the S&P 500. Thinking about the potential for corrections next year, what are your concerns?
Y'all, can I just say first, we have been spoiled as investors in
we
the
have.
best way. I mean, coming out of 22, did anybody really? I don't think anybody predicted that we'd be up 20+%.
VIX of
over the next
13,
few
maybe
years.
even 12, yeah.
I know. It's been a great 2 years, even if it hasn't felt too comfortable. And it might have put us in a place where we're expecting too much heading into next year. I mean, 20% gains for 3 straight years hasn't happened in the S&P since the 90s. And before then, I don't think it happened, in the past seven decades.
I was at a CMT event that's Chartered Market Technicians. So these guys love technical analysis. I wasn't shocked, but I was a little bit surprised how almost universally bullish they were into the end of the decade. And they're not only comparing the present day with the late 1990s, but the 1920s. And people who are market technicians love to go back as far as we have prices. But, there's something ominous there because the 29 crash, Irving Fisher famously talked about it as being this permanently high plateau. It was permanently high for about 2 minutes, and then we got this big crash and everything. So I'm just wondering, how are you advising some of your clients to think about the risks as we head into the new year and just to protect themselves?
Yeah, I think that's the biggest risk, Jared. Our expectations are too high. And that doesn't mean that stocks, could crash next year, but it means that we might be overlooking some of these nascent risks that, could be bubbling up underneath the surface. See, the problem with high expectations, and I love that everybody's happy, it's the holiday season, right? But the problem with high expectations is that you're not as surprised when bad news comes your way. And what I mean by that is, so we have economic data that comes out. We have, the Fed coming out and talking about what they're going to do with interest rates. We have the jobs report. Over the past 2 years, investors have been, clenched up, waiting for the worst case scenario to happen when these economic events have crossed the tape. And they've just been better than expected over and over and over again. We're not in that place anymore. It doesn't feel like we are. Yeah, exactly. We're anesthetized. That is a great analogy for it. And that doesn't mean that the economy may not perform well. It doesn't mean that profits may not grow in 25, but we're expecting that good news. And that means that, we could be let down. We could be getting our hopes up too high.
What are some warning signs then that investors should be looking out for?
I hate calling these warning signs because they're all really good. But, when you see, so there are some sentiment surveys that I watch. There's the AAII sentiment survey. That's individual investors like you and me. There's the NAIM survey of
We
portfolio
need more letters
managers.
there.
That's
I know.
That's fine. You don't have to
Finance
say it.
loves its letters, man. But there are certain surveys that basically ask a bunch of different investors, how do you feel about the market? Where do you see the market going? What are you doing with your own portfolio? And across the board, we've seen a lot of excitement in those surveys, which is great. I love that investors are happy about the gains that we've had this year. But again, it goes back to that, risk, that inherent risk of getting too excited for the future.
How are you thinking about the Trump trade as we come closer to January, where President-elect Trump will be in
Everyone got it
office?
wrong 4 years ago, basically.
They did. And that's the interesting thing, because we seem to be going, not we, but markets seem to be implying that the pro-America trade is basically the only game in town right now. And as you mentioned, in 2016, that was the feeling on Wall Street through the end of 2016, and then things flipped in 2017. So so first of all, I have trouble talking policy because I don't think anybody knows what could happen over the next few months. So we have a lot of clients ask about tariffs or, tax cuts, what's coming on the horizon. And my answer is, I don't know.
These things, as they evolved back in the day, evolved on a day-to-day basis. Literally, information and big picture information would change on a day-to-day basis. So I support that. Take it as it comes.
Right. But there are things you can do going back to balance. November's gains were incredibly imbalanced when it comes to, U.S. versus international markets. In fact, U.S. stocks had their best month versus international stocks in 26 years. They outperformed by 7 percentage points.
Is EM ever coming back? Any discussions to that effect?
We love looking at value in emerging markets. You can't, I think
Well,
value
if you're
is at
low
the top
forever,
of the list.
you're very much in the value for a while.
But I think investors are becoming a little short-sighted here. I think that there's a lot of balance to be had. You have to remember that, markets outside the U.S. are very value-focused. They don't have as much tech, but they have a lot of banks. They have a lot of industrials. They have a lot of energy. And, conditions change quickly. What you expect to happen probably isn't going to happen because everybody else is expecting it too. So I think that's what's going on with the Trump trade, back to your question, Sydney. And I think we could see that balance come back into play at the beginning of the year.
Okay. And I want to ask one more on this bull market we're in, because we talked a little bit about buying the dip. We also used the term correction. Is a dip and a correction the same thing? And when would you advise people to buy a so-called dip?
Yeah, this is a hotly debated topic on Wall Street, by the way.
This goes back a long time. I'm thinking of memes that are
People
over
fight
10
over
years old now.
This was the third rail I just touched.
But I love that you touched it because, I'm in this fight too. So everybody will tell you different things. Jared, you're the technician, so back me up here. But a correction is a 10% drop from 52-week highs.
Basically, that's the way we define it.
Yeah, so 10% drop from a high. That's how, I would define it too. Some people call every sell-off a correction, which I say that's not true, but I understand why you can think that way. So, when we're talking about sell-offs, 5% sell-offs happen a couple times a year. On average, we've seen over the past several decades that's happened. We get a correction once every year or so. The last one that we got was back in October of 23. So what a long-term investor should think about, hearing all of these stats, is that there are going to be ups and downs as you invest. And the drop that you should be worried or kind of on alert for is that big 20% drop. Just because that's where, you see some changes in the economy around, market drops of that size. When you see changes in the job market or, events that people have to digest, around those sizes of drops. 5 to 10% drops are icing on the cake for you if you're
They're
looking
not,
longer
you
term.
want them. And then when they happen, you're like, ooh, this is going down 20%. I'm just going to wait. But that's the thinking. We got to hold that thought, because guess what? It is time for Who Wore It Better. And today we're going to set the stage with a little imagination, John Lennon style. Imagine there's no price inflation. It's easy if you try. No sticker shock in sight. No prices soaring high. It might sound like paradise, but inflation is only one side of the coin. On the other hand, we have the job market. And when we prioritize inflation or its reduction, we often deprioritize employment. And this is where the competition heats up. The Fed has two mandates: stable prices and maximum employment. The Fed aggressively raised rates a couple years ago to combat inflation. In doing so, it knowingly slowed the economy, which also slowed jobs growth. Now, the Fed is cutting rates currently to prevent a bunch of job losses from turning into a recession. So, Callie, here's the question. Who's wearing the Fed's focus better in 2025? And to be fair, this is another way of asking you which is going to be the bigger thorn on the Fed's side next year. Is it inflation or employment?
Well, I'm not a policy analyst, so I'm going to say unemployment. And the reason why I say that is because, of course, there's the threat of tariffs and, more stimulative policy for the economy that could lead to higher inflation. But right now, if I'm looking at the economy as is in a vacuum, I think the job market is definitely at a bigger risk. And that's what the Fed is going to focus on, which means more rate cuts ahead.
Which is what they're doing right now.
Which is what they're doing right now, but gradually. I call them celebratory rate cuts.
All right. So here's another stat from your notes to us that the Fed would have to cut 7 times in 2025 or whatever to get to the neutral rate. And we don't have time to get into exactly that equilibrium rate, but is 7 too many? It just seems like a lot.
It does seem like a lot. And the context you have to add is those are 7 small rate cuts, 25 basis point rate cuts, which is about as small as the Fed will go. But yeah, it doesn't seem like much, right? We already have 2 in our pockets, and I think traders are expecting 4 more next year and 7 more until we get to that magical rate according to Fed projections. So, I think before we know it, we could be talking about the end of rate cuts. And if that happens, that means the economy is doing fine, and that's probably what you want. But I understand that people are super price sensitive right now. There's a lot of complaints, a lot of valid complaints about housing affordability.
Sure.
That plays into what happens with rates. And it's a really delicate balance that has a lot of, big camps on both sides. I'll say it that way.
Very well said.
How do you explain the psychology around rate cuts to clients who are kind of just trying to ask you, what do I do with all my money?
What's the basis point?
Well, that's another highly debated topic on Wall Street. Now, when I talk to clients about rate cuts, usually the situation is more around their own money. Rate cuts are coming. I'm reading a lot about the Fed. What does that mean for my own financial situation? And the great thing is that you can pull some threads there. Lower rates on the short end, because of course the Fed is cutting an overnight rate, mean that you're seeing lower savings rates in your bank accounts. You're seeing lower rates on treasury bills, for example. Those short-term obligations or short-term fixed income that you hold in your portfolio isn't paying out as much. But, and usually you see the long end come down with that too, but that provides a lot of opportunity. You can lock in shorter term financing for lower rates. That's great news. You can lock in longer term financing if the long end of the treasury curve cooperates.
We got 1 more minute. So what's your final word to investors here for 2025?
I'll say it like this. Invest like your legacy depends on it, because it does. And stocks over
That's a lot of
time,
pressure.
stocks over time have been the best asset historically to build wealth in. So I know we talked about a lot of pros and cons heading into next year. Remember that especially if you're in the earlier part of your journey, you have a lot of assets at your disposal, or you have a lot of tools at your disposal, and you shouldn't be too nervous. That being said, we may not see a year like we have for the past 2.
No more 20%.
My legacy is at stake here. All right, we are winding things down here at Stocks in Translation. Be sure to check out our other episodes of the show on Yahoo Finance site and mobile app. We are also on all your favorite podcast platforms, so be sure to leave, comment, and subscribe wherever you get your podcast. We'll see you next time on Stocks in Translation.